Hello, everybody. I'm Matt Garrett, founder and CEO of TGG. And today we are going to talk about alternative forms of debt financing when you can't get a bank loan.
Before we get started, make sure you click on the subscribe button. And if you're on YouTube, click on the alert notification so you can be notified when we post new videos.
So what are the alternatives? If the bank has turned you down, you have no way to get other money in other than bringing in partners, and you don't want to do it because you don't want to dilute your ownership percentages. Well, there are a handful of other opportunities, but beware. These are all dangerous and need to be thought of as only short-term solutions and not long-term solutions. So the first one is, if you don't want to give away equity immediately, you can use something called convertible debt. What is convertible debt? Well, it's exactly what it sounds like. It is debt, meaning you're taking on a loan from somebody that then ultimately they get to the opportunity to convert it into equity at some point in the future. Why is this good for you? Well, you're not giving away equity immediately. So your current profitability, you can still retain 100% of, but in the future, you're going to be giving away a part of the business. So let's assume for a second we don't want to do any of that. What are the other things that we want to start thinking about? Well, there are all sorts of online loan platforms. There are payday loan kind of things. There are AP loans. There are AR loans. There are asset-based lending. There are leases that we can use. There's things like factoring, all sorts of different things. All of them, however, carry huge interest rates and huge fees. So you want to be very, very careful. These short-term small business loans need to be seen as short-term small business loans, because if you're paying 10, 11, 12, 15%, which is as high as some of these get, and in fact, if you're factoring, it can be as high as 30%. They don't pitch it that way. What they pitch it is 3% of your AR as a discount, but it's 3% every single month if you're turning your AR every month. So it can be very, very expensive. The bottom line is, if you're going to consider using any of these alternative forms of debt financing, what you have to do is build a cash flow forecast on how you're going to get out of it. The key thing to remember about debt, and this is what everybody usually forgets, is that if you go out and borrow $1 worth of debt, you need to earn $2 to pay it back, not $1, because you earn $2 and the first dollar goes to the IRS. The second dollar gets to be spent on the debt. So remember, if you take debt out in alternative debt forms, it has to be short-term. You have to have a cash flow forecast to show how you're going to pay it off, and make sure you remember that you have to earn $2 for every dollar you pay off of debt.